Hello. Today we're going to be talking about Form 1099 federal and state reporting with emphasis on state reporting. I'm John Montgomery. I'm the national partner in charge of KPMG's employment tax practice. I've been with KPMG for 18 years and I'm based in the New York City office. My group specializes in all U.S. payroll reporting and withholding obligations related to process and procedures, review and implementation, software implementation for payroll systems, federal, state, and local payroll compliance, and assisting with issues related to multi-state withholding. In addition, I have my colleague Jerry Kahn, who will now introduce himself.
Hello, I'm Jerry Kahn. I'm a Managing Director in KPMG's Information Reporting and Withholding practice. My practice focuses on all things information reporting related, covering chapters 3, 4, 61, and the Common Reporting Standards. Prior to joining KPMG, I worked at Barclays Capital and Bank New York Mellon. My focus at KPMG has been bridging the gap between tax technical and operational tax. Thanks, John.
Thanks, Jerry. Before we jump in, we're going to just cover some logistics and CPE information. This session has been pre-recorded. However, a subject matter expert is participating in the session live to answer any questions you have via the chat. Polling questions will be incorporated throughout the session to verify attendance and qualify you for your CPE credits. Please be sure to complete the session survey to provide us with any feedback. CPE credits for attending this session live will be added to your Synergy CPE certificate, which will be emailed to you following the conference. The recording of this session will also be available post-Synergy, but will not qualify for any CPE credit. Our objectives today are really to help you to identify reporting and withholding requirements of Forms 1099 at the state level. We will also cover states that accept combined reporting with the federal government, states that have separate filing requirements, and states that may require withholding taxes on payments to recipients, as well as for non-resident independent contractor and recipients that are providing services in a state other than their state of residence. So for our agenda today, we will quickly cover a variety of different 1099 forms that are available. But our focus today will be on independent contractor reporting and reporting to pensioners. We will cover that by going through the Form 1099 miscellaneous, the new Form 1099 NEC, and Form 1099R and their federal reporting requirements. From there, we will go into a summary of the combined federal and state reporting program. And lastly, we will cover some 1099 withholding requirements at the state levels, whether it is tied to any required federal withholding, as well as specific guidance provided to us by a few states as noted on this slide, for non-resident contractors performing services in a state. Lastly, we will leave some time at the end to cover any questions that have come through on the chat, which we will be hosting live. So we're going to go ahead and dive in. Form 1099 has a variety of different forms we can use based on the payments that are being made. Form 1099 Div, as it's called, is to report dividends for U.S. and foreign corporations, mutual funds, and non-taxable money market dividends. In addition, Form 1099 INT is issued to recipients who have received taxable and non-taxable interest reportable for a current year. We also have a Form 1099B, which is really around stock transactions. Those are used and reported by brokers and barter exchanges to report proceeds from a transaction to the Internal Revenue Service. And a Form 1099 OID, original issue discount. These are accrual results from ownership of a long-term obligation that was originally issued at a discount from the amount payable at maturity. All of these forms have two filing requirements, one to the Internal Revenue Service, one to the recipient. Most of these forms have a dollar threshold on the 1099 DIV and the 1099 INT that will dictate whether or not a filing is required. As we continue on, and these are the forms that we're going to be focusing on more today, Form 1099 miscellaneous. It's to reflect a variety of payments which we will cover, but also to reflect income from royalty trusts, consent payments, substitute payments in lieu of dividends. We have a new form this year, a 1099 NEC, which stands for non-employee compensation. This form is going to replace the box 7 on the 1099 miscellaneous, but not any other boxes on the 1099 miscellaneous. This was done to capture independent contractor payments and also better to align with federal reporting requirements and the differences between that and the Form 1099 miscellaneous, which we will discuss further throughout this presentation.
John, it also helps alleviate some confusion that occurred in the marketplace with the 1099 MISC Box 7 being due at the end of January to the IRS, and the rest of the form being due at the end of February or March, depending on whether or not you e-file.
Right.
Now you've got two separate forms with two separate due dates. With the 1099 NAC, sorry, I'm probably jumping ahead.
That's okay.
Being due at the end of January, with the 1099 MISC having its own due date, and it's just a one due date. It's at the end of February if you're paper filing, and the end of March if you're e-filing.
Correct. And we will cover that later, but thank you for clarifying that, Jerry. We also have a 1099-R. These are fairly common. We see them quite a bit. These are for distributions from pensions, annuities, retirement, IRAs, or anything that's going to a pensioner. And the last form is a 1099-K. This is a relatively new form in the last few years, and this represents our 1099 reporting for payment card and third-party network transactions. Now we're going to spend some time on the federal reporting obligations for 1099s. As I previously stated, copies need to be filed with the Internal Revenue Service as well as to the individual. If you're filing paper form 1099s, they will be accompanied by a summary form 1096, which is the annual transmittal that summarizes all the 1099s that were reported and the total amounts that were reported on the form. Most 1099s are usually due by the last day of January of the following year. So for 2020, most 1099s will be due on January 31st of 2021. If you have greater than 250 of the same 1099 forms, the IRS requires you to file electronically by March 31st of the following year. New regulations were passed to have that threshold of 250 fall to 100 in 2021 and further below that in 2022. As a result of the current ongoing 2020 situations, these rules to reduce the electronic filing threshold have been postponed. So for 2021, the electronic filing threshold will still be 250. Also, as noted below, for the Form 1099 NEC, our new form will be due on February 1st, 2021, since January 31st falls on a Sunday. The recipient copies of these forms must also be postmarked on that date. So we're going to go to our first question. You should be able to answer this now as you're viewing this live. Do you file 1099s electronically regardless of your thresholds? Yes or no? So if you're under 250, or would you still file electronically? So we'll wait as the polls come in. In my experience, and I'll ask Jerry to comment as well, the majority of companies I see still will file electronically even if they're under 250, just for ease of filing. I don't know what you're seeing, Jerry.
That's my experience also. I think a great number of companies migrated to filing electronically to avoid any issues related to having additional filings come up later on in the year and ultimately triggering penalties because you end up submitting over 100 forms. At which point, you put yourself in a bad situation. So what I'm finding is the majority of withholding agents tend to electronically file regardless of their threshold, John.
Yes, and I'll add on a practical note, anyone that's tried to feed the red paper into printers and had it jam on the last minute, prefers to file electronically.
Yeah.
Okay.
Yeah,
We'll
it's
keep moving.
it's becoming harder and harder for people to order forms. I can imagine with COVID and the difficulties people are going to have this year receiving those IRS copy version of the forms, more and more people will be looking to e-file it this year.
Yes, and I think we're hearing more and more throughout the year, because the IRS offices have also been closed, the extensive backlog of paper returns for all tax types, that the IRS is working to actually log in and accept. There are very long delays on doing that. So a lot of companies that have not done electronically in the past are certainly looking to do that now in the future.
Yeah.
So now we want to focus specifically on the 1099 miscellaneous. This is probably the 1099 form that I spend the most of my time on. When should an employer issue a 1099 miscellaneous form? So we have two thresholds on that. A 1099 miss is also used to report the payment of royalties. To the extent the payment of the royalty is in excess of $10, a 1099 miscellaneous is required. For our other boxes, the threshold is $600. So if you've made payments to an individual for rent, for example, of less than $600, a 1099 miscellaneous would not be required because they're under the threshold. But for payments of at least $600 in the items here, so rents, prizes and awards, other income payments, medical and healthcare payments, crop insurance, which I don't see too often, but it is out there, and fishing boat proceeds, any amounts greater than $600 would require the 1099 miscellaneous reporting. The $600 limit does not apply if there is any backup withholding required. Jerry, do you want to add anything on these 1099s?
The only thing I will add is because of the split out between a 1099 MISC and a 1099 NEC, the boxes are going to look different this year for the 1099 MISC. So for those folks that have software, please work with your vendors to ensure that the software is updated. In the event you have queries that go from your payment system to the software, ensure that the queries are properly updated to align with the new boxes in the 1099 MISC.
Excellent point, Jerry. The form definitely looks different for 2020. So in addition to the items reported on the last slide, this form is also used to report direct sales of at least $5,000 of consumer products. I think the key point on this slide, and this is a question I get quite often, is payments to corporations. Payments to corporations are not reported on a 1099 with the exception of law firms and healthcare payments. I think this is a key question we get quite often. This is where, although it's not necessarily a reporting requirement, this is where we see often companies looking at, do they have the proper processes in place to determine whether or not a recipient is a corporation, an individual, what it may be. That really comes down to the Form W-9. And as you're going to have a payee come on board filling that out so they can verify you their entity classification as well as their federal ID number or social security number, it will help you from a process standpoint to determine who needs a filing of a 1099 and who does not. What we don't want to see is you don't know whether or not they're a corporation, you've filed your 1099s, and then someone calls you in March asking for a 1099 that they didn't receive, and we have to go back and issue some additional forms. Again, the normal due date of the 1099 miss is January 31st. It'll be February 1st in 2021. So now for 2020, we have our new form, the 1099 NEC for non-employee compensation. This form also has a threshold of $600 as to whether or not you have to file it. This is really the replacement of the old 1099 miscellaneous box 7 non-employee compensation. This is really for any payment you make to services performed by someone who is not an employee, so an independent contractor, which can be in a variety of things. I think the old example the IRS always used to use, if you're paying someone, for instance, for cleaning the office, for doing your landscaping, those types of services that you are engaging with someone or an entity to do, but not in the capacity of them being an employee. I think this is also good to note from a 1099 NEC perspective that any payments to an employee, whether current or former, probably should not be reported on a 1099 NEC, and you should consider whether or not those should actually be reported on a Form W-2. The NEC should also be for payments made to an attorney. And similar to the 1099 miscellaneous, we have item payments that should not be reported on the 1099 NEC, which again are payments to a corporation, payments for merchandise, rent, which has always been reported on the 1099 miscellaneous, but those should still be reported there and not reported on the 1099 NEC. Payments to employees, as I stated, and former employees, and payments to tax-exempt organizations. And Jerry, I would think, as we mentioned the systems issues around the 1099 miscellaneous, there's probably going to be some systems review to make sure the 1099 NEC is uploaded and ready to go as well.
Absolutely. This is a whole new form types. This is a whole new form type that withholding agents should be looking at probably around this time of the year if you haven't already done so. Mainly because it usually takes some time to work with IT to get new queries built to get data out of the system. So because there are different boxes, because the IT process is complicated, you want to give yourself as much lead time to work with IT to get the new queries out. You also want to get your new specification from your software provider so that you can get the query to align with the new specification for the 1099 NEC. One other key point, John, is unlike the 1099 MISC, which is due to the recipient at the end of January, but isn't due to the IRS until the end of March if you're e-filing, the 1099 NEC is due both to the IRS and to the recipient at the end of January.
Agreed. And I think especially this year with a lot of companies not in the office, I would move as quickly as possible on the software side to make sure this is up and running. I think what we don't want is, we get to January 15th and all of a sudden something is not working on the new form and it's not being uploaded correctly.
Yeah, this is definitely not something anybody wants to tackle in January with all that goes on in January.
Exactly. And as Jerry just mentioned, absolutely to recipient and IRS by January 31st. And the reason Jerry touched on this earlier, the reason one of the reasons this form came to be was because the 1099 miscellaneous had various filing deadlines. But if you were reporting in box 7, it had to be filed by January 31st, whereas the other boxes did not. So the IRS has carved that box 7 away from the miscellaneous to here, but the absolute filing requirement should be the 31st. And you may truncate the recipient's Social Security number and FEIN. Most of the software systems I see actually are automatically truncating, which is your option. The next form is 1099-R. So when do we issue a 1099-R to an individual? This is for any distribution of $10 or more. So this is a relatively low threshold point on any types of profit sharing, retirement plans, IRAs, annuities, pensions. I always explain to people, like when I think of my old-fashioned like grandparents' pension, a check that comes on the first of the month, every month for an extended period of time. We would normally say that's what we would call a pension that would go on a 1099-R. but it also includes permanent and total disability payments under life insurance contracts, charitable gift annuities. This form tends to be somewhat voluminous since the threshold is a $10 amount. You would also report death benefit payments made by employers not part of the pension, and disability payments made from a retirement plan. So generally on a 1099-R, similar to the statement I made on the 1099 miss and NEC, we don't want to report any payments that are subject to withholding of Social Security taxes or Medicare taxes on this form. Any payments that would be subject to those taxes still need to go on a W-2, even if it's for a former employee. I'll see this question come up quite often for employees that might have a deferred compensation or some type of equity compensation that's paid out after they have retired or left the company and are no longer an employee. To the extent those have a Social Security or Medicare withholding requirement, they would not go on the 1099-R. They should go on a W-2. It is a fairly common error that we see. There are other items, we don't want to report tax exempt, such as workers' compensation, unless it's part of a distribution. So for 1099-Rs, again, we must furnish it to the recipient by January 31st of most years, February 1st for next year, and filed by the IRS by March 1st of filing paper, March 31st of electronic, though most of my clients I see report electronically because of the number of 1099-Rs that they have. One interesting question on 1099-Rs relates to state withholding. State withholding on pension payments that are reported on 1099-R is voluntary. It is something that the recipient can request. Most employers and employees are familiar with Form W-4 or the state equivalence, which is something an employee would fill out to determine their number of allowances and to be used on tax tables to determine what your employee's withholding will be each pay cycle. The federal government has a W-4P for pensions. Most states have an equivalent W-4P where an employee or former employee, now a recipient of this 1099-R payments, can request a percentage of taxes to be withheld from that payment. So now we're going to go to the Combined Federal and State Reporting Program. When you have a 1099 miscellaneous or 1099 NEC state filing requirement, if the state participates in the Combined Federal State Program, the Internal Revenue Service is going to forward to the state for you. And separate reporting may not be necessary. There are going to be situations where separate reporting is necessary, but if the federal state program exists, we usually let the IRS do the work for us. There are about 30 states that are in the federal state filing program, and there are a few states that do not allow the filing in a combined status with the federal government, where an employer may or may not have a requirement at the state level. We'll get into the state pieces. Some states have requirements where 1099s only need to be filed if you've done any state withholding. Some states don't want them at all. And some states will want them regardless, even though they're not in the federal state program. Jerry, I don't know if you had anything you wanted to add on the combined program.
The only thing I'll add there is the number of states that participate keep growing and growing,
Yes.
which will make participation in this much more valuable. And this year there might be a little bit of a gap where I think there's going to be some disconnect between the state and the federal as it relates to the 1099 NEC. So folks will want to make sure they're looking into making sure the 1099 NECs get submitted as appropriate to the states that are impacted by that.
I mean, the 1099 NEC is a new form, but the IRS did give us a long lead time that this form was coming. But I think with offices being closed, including state offices, and state employees working from home. I've not heard yet if states are up and running and ready to receive the NEC or not.
Yeah.
And we'll have to wait and see. Jerry, I don't know what you think. I don't know that that's necessarily going to force someone who's issuing 1099s to have to do a separate state reporting if the state is in the program that just don't have the setup yet, or if it'll just be a delayed reporting from the federal government.
Yeah, I don't know how that's going to play out yet, but it's definitely something that we're advising withholding agents to keep a close look on between now and January to see if there's something additional that needs to be done.
So here are just a few examples of states that require separate federal and state reporting. And again, as Jerry said, states are joining the program more and more, so this could change very rapidly. But Illinois, Kentucky, Louisiana, Montana, Oklahoma, Oregon, Pennsylvania, Rhode Island, and West Virginia require separate reporting. We have an asterisk on a few of the states, and this goes to some of the comments I made earlier where state reporting may be required. Kentucky, Montana, Rhode Island, and West Virginia only want a copy of the 1099 sent to them separately if you've withheld state income taxes. We don't often see state income tax withholding on independent contractors, where we'll see on the NEC. We don't often see it on rents, for example. But there are situations where a state will have withholding. Sometimes it is tied to federal backup withholding, and sometimes it's just a separate requirement. But for these asterisk states, we're only going to have a filing requirement if you've withheld any state income taxes during the year. So we're going to go to our next question, which should be on your screen to answers. Do you file state forms in the states not in the combined program? So for the states I just listed where they do require separate reporting, do you actually do the state filings, or do you only file at the federal level? Jerry, I don't know if you have any anecdotal experience on what you see companies do when they've got 1099s reported in these states that have a separate filing, whether or not they're actually doing those.
I would like to think everyone is trying to be as compliant as
Yes, me
possible,
too.
and
Me too.
people are indeed filing.
Yes.
I do know that where there's an option between submitting the one time to the IRS and the combined federal state program, more people opt to participate there. Then really people don't typically have a burning desire to keep track on how to submit for all the states that require submission, because they're all in different formats. So where it can be avoided, I think most people jump all over that. I even see the technology companies trying to avoid having to submit in many different formats to many different states.
Yes, and I think for companies, this is a perfect example about why software is important.
Yeah.
And where you can use it. I mean, to file these via paper with all the different regulations is certainly difficult.
Yeah. And more difficult this year than any year before this.
Absolutely.
Yeah.
So now that we've mentioned the potential for withholding, we're going to talk about that a little bit. So the Internal Revenue Service will require federal tax withholding. Now for 1099 payments, we call it backup withholding. The main case I see is when we've made payments to individuals who have failed to provide a taxpayer ID number or a valid certification of that number. And when we do have backup withholding, that also has to be reported on the Form 1099, whichever form it may be, whether it's the miscellaneous or the NEC. The backup withholding amount, remember, if we do have any, negates the filing threshold of a $600 limit on the 1099 NEC and the 1099 miscellaneous. Jerry, do you want to add any commentary on the backup withholding requirements?
No, only that a couple of years ago the rate changed from 28% to 24%. So for those that haven't already done so, most people that I've come across have already done so, but thought it will mention it to ensure that people are covering that.
Yes. And backup withholding, it's an extra process. It can be hard to manage. Um, and this is where the key to the process up front comes in. Having that W-9 and that certification from the individual or the entity on their FEIN number should negate the requirement for backup withholding. It will save a lot of headache and a lot of administrative burden in the future if you don't have to do backup withholding.
Yeah, on the practical side, many people struggle to actually apply backup withholding because typically it's a manual process. It's difficult to track, difficult to align your IRS deposits with the amount of money that you withhold. A lot of people that have backup withholding obligations struggle between January and December, deciding what payments relate to December, what payments relate to January. Like John said, the best bet is to do everything you can to properly onboard reportable persons to ensure you don't have a backup withholding obligation. And where possible, make sure you're TIN checking to ensure that the name and TIN combinations are correct, that you get potentially upfront when you're still engaged with the person who gave you that information to get updated information. Because one way of having to enforce backup withholding is if you report somebody who gave you a W-9, but the name and TIN doesn't match what the IRS recognizes, and ultimately they get put on B notice, and you're forced to put them on backup withholding. So it makes, I mean, like John was saying, it makes a lot of sense to do everything you can during the onboarding process to get correct documentation to alleviate the burdens that would come later on.
Yes, and I would say probably even as early as 5 years ago, I didn't have a lot of clients that were working on the startup of the process and getting that, but I've definitely seen some great strides in that in the last 5 years. I think it's certainly with technology, it's easier to gather this information. But it's also as a result of this is something the IRS does look at. They will request the backup withholding. And once a company gets forced into doing backup withholding and the administrative burden around it, they will quickly switch their processes around it. And in addition to backup withholding, some states may require state income tax withholding mandatorily when federal backup withholding is done. So if you end up having to do federal backup withholding, you're adding another layer of complexity administratively in that you may have to do some state and local income tax withholding as well. And not only having to do that withholding, but now you're necessitating probably a 1099 filing requirement at a state level for a state that normally would not require it. I think with my payroll hat on, the other issue to consider is, I mean, obviously often 1099 payments and 1099 reporting can be driven from an accounts payable department. When you have withholding, those taxes normally need to be deposited with the payroll department. Many companies use outside payroll providers. And in all states with a payroll tax, at the end of the year, there is a payroll tax reconciliation report that has to be filed that lists employee wages. And in many states it says, and all withholding taxes paid and withheld this year. That includes state backup withholding in addition to employee withholding. That is very difficult to get a combined reporting of the two when you use an external payroll provider. That may cause additional filings and notices from the state. So the states may require that, and I think it all just goes back to process up front.
Yeah. The one thing I will say, John, just to chime in a bit, with the withholding, while it's difficult, it's by far the biggest exposure that a withholding agent has. Typically, when they're under audit, or if something comes up during their internal audit where withholding should have applied, but it didn't. Oftentimes, it's very difficult to reach out to the vendor or the service provider to get them to pay the withholding. The way the rules work, if you don't have a TIN or in the appropriate format at the time you make that payment, you have the obligation to withhold. And oftentimes when I see withholding agents cut and check to make things right with the government, it's the biggest part of the check is to pay withholding taxes that should have been paid by the vendor or the service provider up front, and just because of a lapse in the process, that withholding dollars were not collected and deposited to the IRS. I don't know what you're seeing on the payroll side.
Very similar, and I think the most we can do on processes to curb that, especially with companies looking at cash flow in 2020 and 2021, this can be a quick way to fix that up. So we're going to go to our next question, which is, do you withhold state income taxes on independent contractors? Yes, no, or considering this for the future. While you're answering that, I would say probably even 3 years ago, most companies would have said no. A good 99% would have said no. But that is starting to change as states are implementing sometimes mandatory withholding on independent contractors, especially non-residents. So now we're going to jump into some of the states that have withholding tax requirements on non-resident contractors. Many of you may be familiar with the concept of non-resident withholding on employees who travel for business. We'll use me as an example. I'm based in the New York office. I travel all over the country. And as employees, you can have withholding in all those states based on sourcing your wages to where you physically perform services. That's probably no more true in 2020, especially with employees now working from home or from other remote locations, and the potential implications of multi-state withholding. That's been a growing trend for about 15 years now, with many states looking for employers to source wages and withhold on employees. The next phase of that has been to start withholding on non-resident contractors who are providing services in these states. The overlying theory from states is all individuals should pay income taxes based on where their income is sourced, to the state where they earned it. States are now expanding that, saying if you have a contractor coming into my state to do work, I'm going to require some withholding, because if I require withholding, in theory, it's going to force the contractor, you're going to report on that 1099 to them, it'll force them to file a non-resident return so that the state can recoup the taxes for the amount of payments sourced and earned in that state. The first state to really do this, not surprisingly, is California, which has a 7% withholding on gross payments if the non-resident independent contractor is paid more than $1,500 for services performed in the state. Maine has a 5% withholding requirement. But interestingly enough, as per our previous slides, only when federal income tax withholding was required. So this is one of the key states that ties into backup withholding. New Jersey's at 7%. South Carolina's rule is fairly new, where the non-resident is performing services in South Carolina temporarily, and compensation exceeds $10,000, there's a 2% withholding requirement. Now, I think the biggest question I get from companies is, how am I going to know? How am I going to know if I'm hiring this contractor, where are they going? That is a difficult question. It's not an easy answer. It's probably not easy to track. But it is something that we're seeing as a growing trend, that states want to see companies track that information and allocate those payments and withhold where necessary. There are 2 states that have very stringent 1099 reporting requirements, California and Pennsylvania. California's is relatively older. Pennsylvania's is relatively newer. And I think I've recently seen some potential legislation for other states to expand to these types of rules in 2021. So the good news is California is a combined federal state in the federal state reporting program. So we don't have to send separate forms to California. As we said before, for the non-residents performing services in California, there's a withholding rate of 7% on gross payments if there's more than $1,500 in services in the state. What California has done is tried to make this very similar to employee withholding in that they want you to use a pay-as-you-go system. So not just withhold at the end of the year or withhold from one payment. They want you to withhold continually and to report and remit those taxes on regular tax quarterly due dates. So April 15th, June 15th, September 15th, and January 15th. Luckily, California does not require an annual reconciliation of Form 1099 and W-2. That goes to the point I was making earlier where if your W-2s and 1099 annual reconciliations are combined reporting for the end of the year, and you've got one system and one supplier reporting W-2 wages and withholding, and another system reporting 1099 withholding, it's difficult to reconcile. Again, the due date for these forms are January 31st through the combined program. So Pennsylvania's rule is relatively new from 2018, a little bit different than California. First off, Pennsylvania is not in the combined federal state reporting program. Number one, so you may have a separate filing requirement to Pennsylvania. This became effective in January 1st of 2018, requiring payers of non-employee compensation, which would be the ones reported now on the Form 1099 NEC, to withhold income tax for such payments for non-resident individuals. The law specifically excludes payments to governments, including the U.S. government, the state of Pennsylvania, and all of their political subdivisions and agencies. Residential rental payments are also exempt from withholding, which is probably one of the good things in this law because of the number of companies that pay rent to landlords throughout the state. So Pennsylvania has a flat withholding rate of 3.07%, required for payments of $5,000 or more annually to any non-residents performing services in Pennsylvania. Withholding is optional on payments less than $5,000. I can't say I can understand why they put that in. I do have some companies that are doing this non-resident withholding in Pennsylvania, but none that are doing it voluntarily if the payments in total are less than $5,000. These forms are also due to the state by January 31st, similar to the federal. The one difference in Pennsylvania is Pennsylvania's annual reconciliation for employee payroll reporting and withholding is combined with the 1099. This administratively can be very difficult when you're working with a payroll provider. To the extent you've done any Pennsylvania withholding, I would make sure to reach out to your payroll departments and they can reach out to their providers to see how this combined filing is going to be done. It has been a difficult process for a lot of my clients that are doing this. One other 1099 withholding requirement is Massachusetts in the last few years passed a law on paid family medical leave. This was really for employees. There is a mandatory requirement for the employer to fund paid family medical leave programs in the state. It is, although the ultimate liability is on the employer, they may pass a portion of the payment on the paid family medical leave to employees. What most people did not realize is buried within this law is that the paid family medical leave withholdings are not only applicable to employees, they are also applicable to independent contractors that you're paying in the state of Massachusetts. Now Massachusetts is part of the federal combined program, but you may have a withholding requirement to Massachusetts. There are a number of rules around this. You are actually, for your independent contractors in Massachusetts, supposed to reach out to them proactively to see whether or not they would like to have this paid family medical leave taken from their payments. If they do, you will be required to withhold it. This has been a very difficult administrative process to roll out for my clients and companies in Massachusetts, because independent contractors are treated as they should be, completely separate from employees, separate departments. These withholdings, though, have to be paid and deposited along with your payroll tax deposits for paid family medical leave from employees. We've not seen any updates on this law. I know there were a lot of questions back to the state around the independent contractors being included because of the difficulty around it. But so far, this is still intact. So I would encourage everyone to just review those rules and see if you do have independent contractors in Massachusetts and what requirements you need to fulfill on that. And that brings us to the end of our presentation.
John,
yes,
before you close up, I thought I'll ask a question.
Sure.
I'm seeing some struggles with people on the federal side as it relates to the reporting of payments of paid family medical to independent contractor. Can you share some practical examples of what you're seeing in that space and how people are reporting that?
To be honest, I don't really have a lot of companies that are doing it yet, but I have a lot of companies that are trying to figure out how to do it. They know it's something they need to do and get a hold on. It had some traction, I think, with lockdowns and companies' offices shutting down. I think some things have been pushed back a little bit. I don't have a good answer yet on how companies are doing it, but I know a lot are looking at it to try and figure out what they need to do.
Okay.
I think one of the problems is, unlike employees, because they're in the payroll system, it's easy to find. Contractors come and go. You may have someone who's a contractor every year for a little bit of time. You may have one that only comes every 2-3 years. And trying to figure that out can be difficult.
Yeah, I'm getting pulled into a lot of abatement letter requests for assistance to help companies write their abatement letters. And that's kind of the struggles that I'm seeing, is that when these payments are being reported to independent contractors, I mean, some companies have thousands of independent contractors that they're making payments to, and sometimes they would make payments to them in the future, or sometimes they won't, but they will never really be able to close the account. So it makes it somewhat of a challenge to write an abatement letter about the next steps that these companies can take, especially as it relates to the paid family medical leave. And sometimes, the majority of the folks that they have will never make a claim in the future, therefore will never have something to be reported. So it kind of leaves a tricky situation. It's not something where someone can just, for example, in a normal, say, 1099 space, on the banking side, you can close an account. In the independent contractor area, it's not the same, and there's a lot of restrictions. So withholding agents tend to find themselves in a bind as it relates to handling B notices, for example, which is a name tin mismatch letter that comes saying that the name and tin for the independent contractor doesn't match what the IRS has on record. And now I'm also seeing it make its way through to the 972 CG, which is the penalty notice that follows that. So companies are being penalized, the $270, $280 for each mismatch that they had, and there's very little recourse that they have to try to abate some of that.
Yes, and I think also on the paid family medical leave front, this is a growing legislative trend. We're seeing a lot of states introduce legislation around mandatory paid family medical leave withholdings and requirements, and so I think this is going to be something that's going to be growing even more.
Yeah, so this is something we'll probably be watching closely as it becomes more mature and more withholding agents are trying to comply with it.
Yes. So we are just about at our time perfectly. So we want to thank you for joining this. We hope you enjoyed it, found it informational. As we said in the beginning, this will be posted. We're going to be going into the chat now to try and answer questions live. And thank you very much. Thanks, Jerry.
Thank you. Yeah.